before we actually get started, I would like to tell you about what is TalkSkill and why you guys as learners should choose TalkSkill. So TalkSkill is an e-learning platform. So we are available in multiple regional Indian regional languages where you can learn different creative categories that we have created for our learners. So we are also so we have categories like fashion, and as Mr. Ali Azhar is here, investment in trading is one of the categories that we are available in, and art and craft is the category. So you can actually learn the things you're passionate about and become an expert in this in your passion. So yeah, so without further ado, let's get started with the webinar. And I welcome Mr. Ali Azhar, who is also known as Mr. TalkStock. And Mr. Ali Azhar is known as TalkStock in social media. So he's available in on Instagram, LinkedIn, and other social media platforms as well. So you guys can check out his page and follow him. So he is a chartered accountant by profession and has been an investor over a decade. And he is going to teach us today about the stock market and how to pick a stock. So yeah, Mr. Ali, why don't you tell us about this?
Thank you so much for that introduction. A very warm welcome to everybody. As Anjali rightly pointed out, I am a chartered accountant by qualification. I started investing at a very early age, 19 to be precise, and I have made my mistakes along the way, ups and downs and sideways, and every which way I've gone. And yeah, basically, I'm here to tell you that the best way that I have found over the years to pick a stock is through fundamental analysis. So now there are two streams. You either choose technical analysis, which is your short-term view of a stock. You take a short-term view of a stock based on charts and different indicators, or you take the fundamental analysis route, which is you study a company, you study the industry that the company operates in, you study what you think the possible future of that industry is, of that company is, and then you pick a stock according, you take an educated guess, and then you pick a stock and you hold it for the long term. A long term now doesn't necessarily mean you have to hold it for 5-10 years. Suppose you pick a stock today and in the next 1 year it's up by, let's say, 100% or by 80%. You can sell it even then. But the rationale for picking that stock is fundamental analysis. Means you study the company, you see what the company is all about, what the future of that company is. So that was first fundamental and technical analysis. So the biggest believer in fundamental analysis, I mean, all your famous investors, the way I look at it is all your famous investors pick stocks as per fundamental analysis only. From India also, we have some very famous investors, the most famous being Rakesh Jhunjhunwala. Then there is R.K. Damani. Then we have some fund managers, Saurabh Mukherjee. All these people are very famous and all of them pick stock through this same method. There are very few traders. There are very few traders who are famous. I mean, only the one that comes to mind is probably Mitesh Patel. So and even worldwide, if you look at the most famous investor, Warren Buffett, or his or his uh, or his partner Charlie Munger, or Monish Parbhai, or Peter Lynch, all of them through fundamental analysis, they study the stock, they pick it, okay, and it performs well over the long term for them. Now, long term is a very subjective term. If you get an opportunity to sell this stock which you have picked for the long term within a certain amount of time, you take that opportunity. Okay, what I'm trying to tell you is the method of picking that stock. Okay, so Warren Buffett, firstly, he says, okay, Warren Buffett says he looks for companies with competitive durable advantage. He's named this word, competitive durable advantage. Means what? It has to, that company or that stock has to have a competitive advantage. Either it's the best in the industry, or it's got some kind of revolutionary process, or it's got a very unique product, or it provides a very unique service. That is the competitive advantage that stock has. Then what is the only word missing? Durable. What is the meaning of durable? Durable means long lasting. Durable means consistent. That company has to consistently deliver good results over a period of time. I'll tell you how the stock market works. Okay, how a stock works. Suppose example, a stock gets listed today. Okay, let's say it gets listed in 2023. This stock performs well for the next 2 years or the next 3 years consistently. Every quarter it has to declare its results. Every year it has to declare its results 4 times, 4 quarters. So every year it will declare its results 4 times. That's what SEBI says, that Mr. Company, if you are listed, you have to declare your results every quarter, which is 4 times. Now this company, if it declares consistent profits over some time, then suddenly you will find the stock price increasing exponentially. I don't know when it will happen, you don't know when it will happen. That's the way the market works. Okay, now I'm a content creator, for example. Okay, I'll just give you an example. This is something where you can relate it to content creation also. When I started out as a content creator, this was a few months ago. Okay, I didn't know much about content. I know my stock market subject pretty well, but I don't know much about content. What I was told is you need to just be consistent, whether it be an Instagram algorithm or whether it be a YouTube algorithm. Put out your content consistently without looking at the result over a few months, and one day their algorithm will reward you. I can say the same thing about the stock market. Okay, and recently, just a side note, the Instagram algorithm has rewarded me recently for my consistency and it's gone up. Okay, so I can say the same thing about a stock. Okay, the stock, if a company, if the management is good, if they know what they're doing, and if the company consistently does well over a period of time, one fine day you will just find its share price skyrocket. There have been instances where I found in 1 year also the company has gone up 400, 500%. That means 4 times, 5 times. And people say, oh my God, what has happened? What has happened is not sudden. What has happened is in the past. This company has consistently performed well over a certain period of time. And one fine day, the stock market decides to reward it. Okay. So, like I said, Warren Buffett looks for companies with competitive durable advantage. Okay, now how do we know which company will have a competitive durable advantage? Where does Mr. Warren Buffett go? Where does he look for competitive durable advantage? He looks in one place. He looks in the financial statements of the company, for which you have to make your peace that you have to know a little bit of accounting. Okay, every company listed on the stock exchange has to declare its financial statements, has to declare a set of three financial statements. Okay, they have to declare a set of three financial statements. What are these financial statements? One, there is something called a balance sheet. What is a balance sheet? A balance sheet is, well, you can say it's a table, okay, that shows your assets on one side, what you own. Assets are what you own, something that you own that derives you value, or that earns you money over a period of time. It could be anything. It could be a piece of land. Okay, it could be, let's say, assets are even software. If you've developed a software which you provide services through, that software you have in one place, that same software will help you generate revenue over many years. So this is what assets, these are essentially what assets do. Assets are something you own that give you the ability to derive income over a period of years. Machinery, okay, land, machinery, buildings, softwares, anything. Okay, so you have your assets on one side in the balance sheet and you have your liabilities on one side. Assets are what you own, liabilities are what you owe. How much do you owe to different people? तुमको कितना कर्जा है, for example. Okay, how much do you owe to the banks? How much do you owe to your creditors? Okay, so your assets on one side, liability on one side, both of these have to balance. The total of assets have to be equal to the total of liabilities. That's why it's called a balance sheet. Okay, balance sheet always balances. Okay, So this was one financial statement a company has to give. Okay, that's what SEBI says. Give me three financial statements. The second one is called a profit and loss account. Now, what is a profit and loss account? A profit and loss account is basically your income account. How much revenue, how much sales are you deriving? What is your expenses incurred in deriving that sale? So from the sale, from your revenue, you minus expenses. What do you get? You get your profit or loss also. In case if your expenses are more than your profit, then you have a loss also. So you either get a profit or you either get a loss. This statement, profit and loss statement, okay, statement of profit and loss or income statement shows precisely that. How much a company has earned, what are the expenses, and how much profit or loss. Now, there are many heads under which expenses can come, which for which you need to know basic accounting. Okay, there can be expenses. Now example, there can be staff expenses, there can be administrative expenses, there can be selling expenses, there can be depreciation, which is a non-cash expense. So these are you there can be your interest expense. If you've taken any loan, you have to pay interest on it, correct? That expense. So these expenses are categorized under different heads, which we will come to. So we have one balance sheet, we have one profit and loss, and something called a cash flow statement. Okay, there's you have to prepare a cash flow statement also. Okay, a cash flow statement is basically how much cash you are generating, how much cash you are generating. Okay, so Warren Buffett says to find a company with competitive durable advantage, I look in the financial statements. Okay. Now, for this, you have to know the basics of financial statements. You don't have to become a chartered accountant. You don't have to be an expert in accounts just to read and understand financial statements. Okay. I'll tell you now exactly what to look for, what not to look for, where to look for it. Where to look for it. And Mr. Warren Buffett also says he's like, accounts is the language of business. If you don't know accounts, you have no business picking your own stocks, at least the basics of accounts. You don't need to know as much of accounts as Mr. Warren Buffett or as a chartered accountant, like I said. Okay, so these three are the financial statements. Okay, and you need to look for them. Okay. Now, where do you find these financial statements? See, in today's day and age where we live now, there are so many resources available at our disposal. Okay. So now where would I go to find the financial statements? You can also find it in the same place. There are many websites. Okay. I'm going to just name three websites. Okay. Which I have been through personally. Okay. One is something called Ticker by Phenology. So even if you go on Google and you type Ticker by Phenology financial statements, they'll just ask you for your email address and probably phone number. You'll get an OTP. Just enter that, and you have access to that website called Ticker. Now that Ticker is for all kinds of analysis in the stock market. It also gives you a very basic trend line. It gives you a basic financial statement. That is Ticker. Then one more very famous app is called Grow. I'm sure you all have all heard of Grow. GROWW. It's an app where you can buy stocks also from, and also it has good it presents the financial statements also very well. Okay, but now my favorite and probably the most popular website for seeing the financial statement is something called Screener. Okay, Screener stocks. So if you go to your Google and you just type Screener stocks, and the first link that comes up, if you press it, you're in Screener website. In Screener website, all you have to do is type whichever company you are looking for. Okay, now I'm not saying you have to go through all this elaborate process. Okay, you don't have to go. There are 7,000 companies listed on the stock exchange. Okay, 7,000 companies are listed on stock exchange. I'm not saying you have to go and look for the best 200 companies and go through the financial statements and the annual reports and everything and then come to a conclusion. Okay, this I should buy this company, I should not. But in today's day and age, there are a lot of tips and there are a lot of anonymous tips thrown around. Correct? If you're looking for some anonymous tips, you can go to your friend, family, cousins, uncles. Everyone will have one tip. Oh, I buy this stock or I buy that stock. Okay, fine. You've got this information. Now let's say you've got 5 tips. Okay, the least you can do is verify those tips. Okay, verify it. How do you verify it? By simply going to screener.com and seeing, does this company make sense for me to buy? Okay, Does it actually make sense for me to buy this company? These are the tools I'm giving you. You may get that, you may get that advice or that tip from anywhere. Tomorrow you're reading a business newspaper, tomorrow you're scanning through your favorite financial app, okay? You come across something that makes sense to you. You have to verify it, you have to cross verify it via fundamental analysis. You have to cross verify it by going to screener app and just seeing if the basics are in place. Okay, if somebody is telling you to buy a loss making company, you have to think, at least question them. Why are you asking me to buy this loss making company? Okay, somebody gives you an anonymous tip, no, the best thing to do is just ask them, why are you suggesting me this company? Why are you suggesting me? Probably, most probably 90% they will not have an answer. Oh, because I got suggested from there. So in effect, you're playing Chinese whispers, correct? Someone is telling someone, and that someone is telling another someone, and the whole chain is going around. And where is it leading to? Nowhere. You please break that chain. You should be in a position to break that chain, okay, and cross verify facts. And if you like what you're seeing, go for it. But just question why. Because we live in an age of information overload. Okay. I'm telling you literally, one, there are so many analysts out there, there are so many newspapers out there. There are conflicting opinions between two experts. There are conflicting opinions between two business newspapers. One will say, no, don't buy the stock. The other will say, buy that stock. So it's like, who is whispered in your ear first? You should be in a position to verify those facts. Okay. Now, what I'm going to do is simple. I go over here, I go to Google, okay, and all I type is screener stocks here. It's in my prompts, okay, screener stocks. I go there and I go to screener website. This is what the landing page looks like. Okay, I go to a company over here. Let's say any company you can choose. Okay, I'm going to choose today Infosys, since it's a famous company, since it's a good company. There it is, Infosys. Okay. Now, when I type a company, this is what I get from Screener. I get all kinds of data. Okay. And I'm going to go down over here. You're probably going to get scared looking at all the numbers, but don't be. All right. See this? See this? Look at these tables. Oh my God. Too much information overload. We just need to know how to filter this information and what to look for. Okay. First, when you go to screener, you find out a little bit about this, about the company. So it's written over here. Infosys provides consultancy, technology, outsourcing, and next generation digital services to its clients, whatever. There are some more key points. Read about the services. What kind of services does Infosys offer? It provides digital services, provides core services, provides products and platform, revenue breakup. They are giving you the revenue breakup as to what industries it caters to. See, financial services gives it 32%, retail gives it 15%. Then it has a clientele overview. So you have a bunch of information. Okay, if you're interested, you can read it. Anjali, I hope you can see my screen.
Yes, Mr. Ali, I can see it.
Okay. Now, what do we need to do? Like I told you need to be aware, just be aware of three financial statements. One is the balance sheet, one is the profit and loss account, and the other is the cash flow. Okay. So I'm going to go down over here. First, we have a peer comparison, means which other companies are in, is Infosys like? What are its rivals? Like, what do the listed rivals look like? Okay. And what are the other companies in that industry? So you have Infosys' main rival over here, TCS, Tata Consultancy Group. Then you have Infosys. Then you have HCL Technologies. Then you have Wipro. So which industry is this in? This is in the software industry, IT industry, IT software. These are all its competitors basically. Okay, they have your price, you have CMP, you have P ratio. Now all these are alien concepts to you, which I understand very well. Okay, now what I'm looking for basically is, what do you need to look for? There are a couple of things you need to look for in a company. Okay, the five absolute basic things you need to look for in a company is rising trends. Means every year, is the company actually doing better than what it did last year? So you have rising trends of revenue, you have rising trends of profit, you have rising trends of reserves. Okay, all these are good things, they should be going up every year. Okay, one is rising trends. Second is PE ratio. There is a very important ratio to value a company basically. Okay, to say that a company, whether the company is valued, whether it's overvalued or it's undervalued. It's like this. For example, if I tell you if I give you a figure, if I give you 20 lakh rupees, you'll say, okay, this is 20 lakh rupees. Now, if I'm telling you, you can get a Maruti van in 20 lakh rupees, you'll say, oh my God, why is so much value being given to a Maruti van? This Maruti van is overvalued. 20 lakhs is overvalued for this Maruti van. But if I tell you the same thing, you can get a Mercedes in 20 lakhs. You'll say, very good. This Mercedes is undervalued. I will buy it. So PE ratio is a ratio where you assign a value to a company, saying the value of, let's say, for example, the value of Infosys is 100 rupees. Okay, you will say Infosys value is 100. Yes, I will buy Infosys at 100. But if I tell you a small IT company for 100, you'll say no, that's too much value. That's too much value you are assigning to this company. So PE ratio tells you that. Okay, one we are supposed to look for is rising trends. One is PE ratio. What is the average industry PE ratio in which this company operates, and accordingly, what is our what is our company ka value? Then we have to look for something called cash flow from operating activities. Okay, cash flow comes in three flavors. Even if you don't understand everything I'm saying, just try to remember this, so tomorrow when you're reading about it, these concepts are not alien to you. Okay, cash flow, like I told you, cash flow is one of the three financial statements. Okay, now within cash flow also there are three parts. There's cash flow from investing, there's cash flow from operating, and there is cash flow from financing. I'm telling you, look at cash flow from operating activities. Cash flow from operating activities always should be positive. Number three. Number four, we should look at the debt. How much debt does the company have? And for looking at the debt, there are two ratios. One is called debt equity ratio, and the other is called interest coverage ratio. So, for example, if I tell you the debt of Infosys, okay, if I tell you the debt of Infosys is 20,000 crores, okay, you'll be like, okay, that's not bad because Infosys earns so much money every year. It can pay off 20,000 crores. Okay. But now, if I tell you a small company has a debt of 20,000 crores, you'll be like, oh my God. So again, it's all relative. It's all relative. For Infosys, that may not be a lot, but for a small company, that's a lot. So, how do we know, with what metric do we judge? We judge it by the metric called debt equity ratio. Okay, that's a relative aspect. And the fifth thing you should look for is a healthy order book. That how much orders does this company have? What Mr. Warren Buffett says is, Mr. Warren Buffett says that your financial statements should be consistent. Means you should be consistently making year after year profits. You should be consistently, your sales should be going year after year. It's not that one year my sales are 1,000 crores, the next year it's going to be 300 crores, and the year after that is going to be 1,500 crores. Not like that. I want consistent profits. 1,000 crores, 1,100, 1,200, that is a much better metric. Now, the one thing that drives, guys, the most important thing that drives share price, always remember, when does share price of a company increase over time? When the profits of the company increase. If the profits of the company are increasing year after year, one fine day you will find that the share price has just blown out of control and you are a rich person. Okay, I remember Rakesh Junjunwala started his investing journey with, I think, 5,000 rupees in 1985. Okay, and he ended up, he just recently passed away in 2022. He was worth 30,000 crores. Okay, that's what it was, from 5,000 to 30,000 crores. Okay, and he did these same metrics that we are going to do. He looked for companies basically that gave him a lot of profit. Okay, profit, your bottom line. His most famous stock was Titan. So I think he bought Titan when Titan was 7 rupees, and Titan has now Titan is somewhere close to, I think, 2,500 rupees, but it has given bonuses many times. Sorry, it has split its shares many times as well as given bonuses, not just 7 to 2,500. That is not what you're looking at. So example, if Titan went from 7 rupees one day to, let's say, 10,000 rupees, then they split that 10,000 rupees into 5 shares of 2,000 each. So after splitting and after giving bonus issue, okay, he made a lot of money in Titan. Another very famous stock of his was Chrysler. Okay. So first you need to clarify, you need to understand which sector does this stock you are picking belong to. in India, I will give you a couple of good sectors. One is our IT sector. Okay, in India, IT sector, our IT sector is probably one of the best in the world, easily in the top three in the world. Okay, so IT sector is a good stock. Okay, IT sector is a very good sector. Another very good sector is called chemical sector. India is now India has now many good companies into the chemical sector. We are stealing business from China over there. Another very good sector in India is the defense sector. What is happening with the defense sector? Let me tell you that. In India, till a few years ago, we used to import most of our defense items. Okay. Now, PM Modi has made it his target that we don't want to import much more of defense equipment from abroad, your Rafael fighter jets, and I don't know what not we used to improve. We want to make in India. So, lot of budget, when our budget is there, our budget is coming up in the next 1 week. Okay. They have allocated a lot of money from that budget to the defense sector. So all the defense stocks will do well. Why? Because till couple of years ago we were importing everything. Now the government is saying no, you make more over here. So obviously their order book will go up. Means they will get a lot of orders, which is what is happening, which is what defense companies are seeing right now. Defense companies are seeing a lot of orders. So if they have a lot of orders, what's going to happen in the next few years? You're going to have a lot of sales, right? Today you have those orders will get translated into sales. And if you are running your show properly, those sales will get translated into profits. And if you show profits for consistently for over a few years, what happens? Your share price booms. That's how you pick a good sector. Another sector over here in India, I would like to tell you all is the ethanol sector. What happens is India, our biggest import item is oil. Unfortunately, India is not we don't have many natural resources. Okay, we are not gifted in that sense. We're not like Russia. Okay, Russia's full economy runs on natural resources. Natural resources means they have a lot of oil, they have a lot of natural gas. Okay, in fact, one US president said, he said of Russia once, Russia is a uh, Russia is a fuel station masquerading as a country. Literally, he said that. Russia is a fuel station masquerading as a country, but India doesn't have that. So what does India do? India imports a lot of oil, okay, and that's burning a big hole in our pocket. So now what the government has done? Government says, you know what? Instead of our petrol diesel, now we'll mix something called ethanol in our petrol and diesel. Ethanol is a biofuel. It is basically fuel generated from crops such as sugarcane, rice, maize, etc. Now we have a lot of crops, like example, the whole UP, Maharashtra, we grow so much sugarcane. Okay. So the byproduct of sugarcane, we are making it into something called ethanol, and we are mixing ethanol with petrol and diesel. Now, can you imagine how many million liters of ethanol we will need? Can you imagine how much machinery we will need to convert those crops into ethanol? This provides a huge opportunity for companies. So this sector, again, I'm very bullish on the ethanol sector. So you look for companies, you look for sectors that you think will perform well over the next few years. You look for defense sectors, you look for ethanol, you look for IT. Okay. Now, in IT, generally, we have chosen Infosys. Okay. Now, we will go over here and we will figure out, what did I tell you? The first thing to look for is rising trends. Rising trends of what? Rising trends of sales. I'm first going to my profit and loss account. Okay, one of the three financial statements. Remember, balance sheet, profit and loss account, cash flow. I'm going to first my profit and loss account, where I will see my sales, then I will minus my expenses from sales, and I will come to profit. Now, I'll show you the meaning of rising trend. Look at this first line over here, sales. Oh God, wait. Yes. Can you see these figures? Sales. In March, see, look, they are comparing year after year. Okay. So March 2011, 12, 13, 14, 15, like that for 10 years. In March 2011, the sales of Infosys was how much? Can you see? 27,501 crores. Increased to 33,000 and something crores. Then increased to 40,000. Then increased to 50, 53, 62, 68, 70, 82, 90, 1 lakh. Can you see this is a rising trend? This is a rising trend. This is a sign of a good company. Year after year, they are giving you good results. Okay. Then Below this, we have expenses. Okay, forget expenses. Expenses will also rise in proportion to sales. Then, after you minus expenses from sales, these are your direct expenses. Okay, these are your direct expenses that are directly incurred in getting those sales. Now, for Infosys, what can those expenses be? They have to pay salaries. Yes, correct. They might have to pay office rent if they've rented an office. Yes. They might have to pay some kind of expenses to buy, let's say to run their software. Yes. Okay. So these are all direct expenses. When you minus your direct expenses from your sales, you get something called operating profit. This is not your final profit. This is your operating profit. Let's have a look at operating profit. Okay. And see the trend over here again. Can you see this trend? First year it's 8,970 crores, let's say 9,000. Next year it's 10,000 something. Then it's 11,000. Then it's 13,000, 14,000, 17,000, 18,000. Again 18,000, 20,000, 22, 27, 31. Again, it is a rising trend. Okay, this is the sign of a good company in a good sector. I've chosen the sector, correct? I've chosen IT sector. Now I'm going through the financials and they're all showing me very good. Okay. Then we have something called operating profit margin. Okay, guys, Warren Buffett loves this. He loves what? He loves to see margins. Okay. He says competitive durable advantage means what? Your margins have to be consistent. We don't want one company with margins. First year is 2%, next year is minus 2%, third year is 12%. No. See the margins of Infosys: 33, 32, 29, 27, 28, 27, 27, 27, 24, 25, 28, 26. It's there about. Let's say 25 to 32. It's there about only. These are good consistent margins. We don't want margin. It's not possible to have rising trend in margins. Okay. So we have operating profit margin over there. Then we have interest income. We have interest expenses, depreciation expenses. These are all expenses that are not directly incurred in your sales. Okay. If I'm paying interest to the bank, is that I'm paying interest to the bank, is that interest expense directly, is it related to directly my sales? No, it's not related to my sales. It's not like I'm paying office salaries or I'm paying rent or something like that. These don't affect my sales. Okay, these are separate income. So we have some other heads of income: interest, depreciation. Okay, then we have profit, we have tax. This, ladies and gentlemen, is the most important figure you will find: net profit. Okay, it is called net profit. Again, I'm highlighting it. Let's see the trend in net profit. 6,000, 8,000, 9,000, 10,000, 12,000, 13,000, 14,000, 16,000, 15,000, 16,000. Can you see this? It is again a rising trend, which is an excellent company. Over the years, Infosys has been a consistent compounder. Whoever had Infosys in their portfolio has done very well. This is how you see rising trends. Okay. Now, conversely, I'll show you a company. Okay, I'll I'll tell you about a company firstly. This was Infosys we had. Now I will tell you all about a company which has inconsistent trends. Okay, there are certain sectors which are very competitive. For example, telecom sector. For example, airlines. Okay, very competitive. Like example, what happens in the airline business? There are so many airlines. Okay, if you go to goibibo.com, for example, you're traveling from Mumbai to Goa. Okay, you go to goibibo.com, you get a comparison of all the different airlines giving you ticket prices. Okay, let's say 3,000, 3,500, 3,250. You find 7 8 options of different airlines. What are you going to do? You're going to go to the airline with the cheapest option and click over there. Correct? Even if it's 10 rupees cheaper, you're not going to think in that position, oh, this guy gives me better, this airline gives me better service than that airline. No, because they're all same only. They're all unnis bees only. There it is. What will you go? You'll go to the one that gives you the least price, even if it's 10 rupees cheaper, and you will click that. Now think about it from the point of view of the airline, them running the business, how difficult it is, how competitive it is. Same thing for telecom firms also. Tomorrow you have three options. You have Vodafone, you have Idea, and you have you have Vodafone, you have Airtel, and you have Jio. You will look at which plan is offering you the cheapest and which other bundle service are you getting for the cheapest. You will go and select that only. So telecom and I'm just to give you an example, telecom and airlines are a very bad industry. Now let's see an airlines company. Okay, see what happens over here. Okay, wait. SpiceJet. Let's see SpiceJet. Okay, I come over here. Okay, profit and loss account of SpiceJet. Okay, yeah. 2000 going to 3000 going to 5000 going to 6000, good. Then again 5000, 5000 again is going to 6, 7, 9, 12. Then again is come to 5000. Then again 6000. Can you see it is not consistent? Okay. Then you minus the expenses, you get profit, you get operating profit. Now again, look at this operating profit figure. 60 minus 595 minus 195 minus 847 minus 613. Then we have again plus 546 plus 545 764 minus plus, it's all over the place. This is not called consistency. This is not called consistency. Look at the margins again. Okay, look at the margins. Mr. Warren Buffett's favorite, margins. First is 2%, then is minus 15%, minus 4, minus 14, minus 12, 11, 9, 10, 0. What's happening? Okay, then our final figure, net profit, where it all comes down to it. Look at this. 101 minus 606 minus 191 minus 1000 minus 697 450 430. You understand where I'm going with this? So one is called consistency, one is called inconsistency. I think someone's asking me a question. Just let me. Okay, no one's asking me a question. So this Infosys was an example of a consistent company that has delivered good results, and its share price has gone consistently up over the foreseeable future or past. And then we have one more company, SpiceJet, that has been very inconsistent. So if you own SpiceJet for 10 years, no, few years you would do very well. The stock price should go up. But then after those few years, the stock price would go down. And whatever price has gone up, it is going to come down even further. Another example of industries that are not, which I would not advise you to go in, is metals industry. Okay, metals, steel, aluminium, those kind. Like you have Tata Steel, you have Vedanta, you have Hindalco. These are all big steel companies. What happens with steel companies is now they are very cyclical. For 5 years they will do very well, and the next 5 years they won't do very well. So these are not the kind of companies that you want to look at. Okay, so this was a profit and loss account. Our second statement, remember, is balance sheet. Yes, see this over here. These are the assets. First are liabilities. These are the liabilities over here. The total liabilities. Can you see this total liabilities? That means this is the total amount of money you owe. Whether you owe this money to the banks, whether you owe it to your vendors, whether you owe it to the company itself. Okay, these are all covered. Okay. So all these total liabilities have to match the total assets. Can you see this total liabilities figure of 1110? And can you see this total assets of 1110? They have to balance. This balances, that balances, everything balances. Okay. Here, what you look for now is very important. You look for two things in the balance sheet that's very important in the liability side. One is reserves. Okay, let's not look at SpiceJet. Oh God, I don't know what we are doing. Let's go back to our Infosys. Okay, I go here, Infosys. I come down over your balance sheet. Okay. Reserves. Can you see, you know what are reserves? Reserves are how much money you have stashed aside for a rainy day. Okay. Think about yourself when you were young. If your mom and dad gave you some pocket money, if they give you 1,000 rupees, let's say they give you 10,000 rupees a month. Okay. Out of that 10,000 rupees, you go and you spend 6,000 rupees and you keep 4,000 rupees for reserve. Okay. You keep 4,000 rupees. So this 4,000 rupees that you have kept on the side is your reserve. Yes, someone has raised their hand.
Yes, someone has raised their hand. Yeah, you can comment down your queries, Syed Sufeya. Yeah, you can do that.
In case I miss a comment, can you just please tell me, Anjali?
Yes, yes, I will do that.
Okay, great, great. Okay, so this reserves is a very important reserves is a very important figure. Okay, look at the reserves of Infosys, guys. It is continuous.
Actually, Mr. Sorry to interrupt. Actually, Mr. Abbas is asking, is it the right time to buy Nika stocks?
I mean, Nika stocks has gone very down right now, and if you're looking at it from, it's a little bit risky, but I would suggest yes, buy it because it's gone so much down. Look at it from a point of view of 2 years, 2.5 years, you can buy the stock now. Okay. Now, anyways, let's get back. Okay. Look at this reserves figure. Again, it's going up 25,000 to 31,000 to 37,000 to 44,000 to 50,000 to 60,000. Again, it is a continuing trend. Okay. Another very important thing you look for in the balance sheet is your debt. Look at this total debt. Sorry, this is not total debt, borrowings. Okay. Your borrowings now, ideally, it's okay even if it goes up, but it should be in control. It should be in limit, and ideally it should come down. So these are the few things. I can't get into detail of everything right now. I just wanted to give you an introduction that this is what you're supposed to look for in the profit and loss account. This is what you're supposed to look for in the balance sheet. And finally, we have something like I told you, cash flow. Okay. Cash flow, I told you, it comes in three flavors. Okay, first flavor is operating activity, second is investing activity, third is financing activity. Out of the three, the most important is operating activity. Your cash flow from operating activities always should be positive. Okay, couple of years it's okay even if it's negative, but mostly it should be positive. Here we have positive operating cash flows of Infosys. Look at it: 4,000, 6,000, 7,000, 9,000, again 8,000, 10,000, 11,000, 13,000. Again, these are good figures. Okay, so these are the small little basic things. Of course, I can't get into it now fully, but these are the small basic things you should look for in the financial statements of a company. You have three financial statements: cash flow, profit and loss account, and balance sheet. These are small things you should look for. Other than this, there are few important ratios you should keep in mind while looking at a company. The most important ratio, guys, is something called ROCE. What is ROCE? ROCE is return on capital employed. Return on capital employed means what? To do business, you have to employ a certain amount of capital. Employ a certain amount of capital means what? To start your company, to start your company, you need a certain amount of money to start your company. How? From where you're going to get that money? Either the company takes that money from the owners, or either the company takes it from outsiders. Company takes it from insiders, which is the owners. Company takes it from outsiders. Outsiders means what? Banks or anyone who else finances you. So all this money the company has collected, some from the owners, some outsiders, and now the company has, let's say, 1 crore rupees. Company invests is 1 crore rupees every year, and company earns a certain amount of profit on this 1 crore rupees. Let's say the company earns 20 lakh rupees every year on this 1 crore rupees. That means your return on your capital employed is 20%. Your capital is 1 crore and you got your return of 20% of 20 lakhs. This figure ROCE is extremely important. And a good ROCE, a good return on capital employed is 20, anything above 20%. So like that, there are few ratios. Okay, in accounting, now when I used to teach 11th and 12th standard kids, no, in their portion we had 17 accounting ratios. 17, 1 7. Okay, you don't need to learn all, just learn the important one. One was return on capital employed. See that the return on capital employed is about 20% always. Then is return on equity, which is also similar, but there is a difference. You can go and google the difference. Okay, ROCE, ROE. Your return on equity should be 15% and above. Okay, then there are other, the one of the most important ratios, like I told you, is PE ratio. What does PE ratio show? PE ratio shows whether your firm is overvalued or whether your firm is undervalued. Okay, so there is a formula for PE ratio. The formula for PE ratio, if you must know, is market price per share upon earnings per share, and you get it in number of times. Means what? Basically, your PE ratio, everybody should know this ratio while picking stocks. Okay, how many times how many times is of earnings is your market price? Means what? Let's say a company has a share price of 100 rupees. Let's say a company has a share price of 100 rupees, and the company earns 10 rupees per share every year. Okay, company earns 10 rupees. Means how many times of its earnings is the share price? Share price is 100 rupees. Share price is 100 rupees and company is earning 10 rupees. Companies, this P ratio of the company is 10 times. 10 times means my share price is 10 times that of my earnings every year. Okay, that's your value 10. Now, if I'm telling you my share price is only 5 times my earnings, isn't that a better thing? You can buy me, Mr. Company, you can buy for 100 rupees, okay, and you are paying only 5 times my earnings, which is better than paying 10 times my earnings. You are getting more value. You are getting more value. So the lower the PE ratio, the better. So these were some ratios which you should know. Okay. So you need to know. I'm just telling you what all you need to know before if you want to do your own fundamental analysis and pick your stock. You need to know a few ratios. You need to know the three financial statements. Then you need to go to Google or you need to go read a newspaper, whatever, and see that whether this company has healthy order books or no. Okay, consistency of financial statement is a must. Is a must. Okay, like I told you, these two ratios, ROCE, ROE, and one more very important thing which Mr. Warren Buffett loves is margins, like I told you. These ratios, these 17 ratios now are divided into four things. Okay. There was liquidity ratio, there was solvency ratio, there was activity ratio, and one more which even I can't understand. I can't remember now. Okay. So you need to look at ratios, you need to look at these three financial statements, okay? And you need to read about the company in general. Mm, just give me a minute. Okay, now there are plenty of resources out there. Okay, this was just a basic of what you should be looking for in the financial statements. Mr. Warren Buffett says if you don't know how to read a financial statement, you have no business picking your own stocks. Just go pay money to a mutual fund manager and let that mutual fund manager manage your money. You have no business picking your own stocks. And if you're going to go off anonymous tips over the long run, that's going to hurt you, whether you like it or not. It's like playing a roulette, a Russian roulette. You rather go and play Russian roulette than take anonymous tips and just sort of just buy stocks based on that. Okay, you need to know how to read accounts and you need to know how to pick your own stock. Okay, now I'm going to give you all a couple of resources which you all should ideally read, or you all can a couple of apps, couple of websites. Okay, now a good place to start, a good place to read about companies is newspapers, business newspapers. Okay, now there are the five standard business newspapers. Out of them, the two best ones which I find are Business Standard and Mint. These two are very good newspapers. Economic Times is fully commercial, it's like an ad. So please try to stay away from Economic Times. It's just the most famous paper. Business Standard and Mint are good papers too. Then, now good apps. Okay. Money Control is the best app. Please download Money Control. It will give you prompts. It will prompt you with different articles. It will take you a few days to figure out that app. Okay. But it's simply the best app. It's the biggest app probably in the financial space, and it is the best app. Other apps are there, Stock Edge is there, and one, two more. Even they have Ticker by Phenology, that's there. Okay. A good website to do research is Value Investing. Value Investing is a good website to do research. Okay. Sorry, not value investing, value research. Value research is a good website to do research. It tells you everything all about stocks. It tells you about mutual funds. It tells you about ETFs. It tells you about everything. Okay. So we have Business Standard and Mint as newspapers. We have Money Control as an app. We have Value Research as a website. Twitter is another very good place for your stock market information. Follow some good Twitter handles, get a handle of Twitter, and it's some good, and you get some good information out there. Then I'll tell you two YouTube channels to watch for stock market if you're interested. Okay, two YouTube channels. One is called Raghav's Value Investing. Let me just so two good YouTube channels which I also watch and which I endorse basically. One is called Raghav's Value Investing and the other is called SOIC. Check them both out. SOIC stands for School of Intrinsic Compounding. These two are very good YouTube channels. So get used to reading business newspapers. And guys, my advice to you is honestly read read more newspapers, reports, and all instead of reading on the phone. What happens is, no, reading newspapers, you can read longer articles over there. You can't read long articles on your phone or your iPad, or it's such your attention span isn't that much. So if you want to truly know about a subject, or you want to truly know about a sector or anything about a company or anything, I would advise you to read physical newspapers or reports or something like that. It'll stay also better with you, and it'll come in the form of a story. So read newspapers, go through apps, have some websites handy. Twitter is a good tool for all this, and a couple of YouTube channels. Your knowledge will improve. And as you sort of just explore screener by yourself more, you will only know what to look for. And last of all, uh, guys, my platform on Instagram is Mr. Mr. TalkStock, where I try to educate everyone on investing, and investing in the right way. It's more educational. It's not tips just thrown around, or it's not trading. Buy this stock tomorrow, it will go up. No, it's I try to educate people as to the logic that why should you pick this stock? Why is it going to do well? Okay. So I'm across Instagram, YouTube, Twitter, LinkedIn, Facebook, everywhere. Look me up on I would suggest look me up on Instagram and look me up on YouTube. I make long videos also on YouTube, and my shorter videos are on Instagram. So I'm going to leave, I think, the link over here. I'll just write it down. My Instagram handle is Mr. Stock. There it is. And you can look me up on YouTube also.
YouTube as well, right? So Mr. TalkStock, as Mr. Ali Azhar, is available in all these platforms. You can definitely follow him and gain some valuable tips about stock market and investing, as he said. And thank you, Mr. Ali, for joining with us today and giving your this valuable words about how to pick a stock. And I think so everyone learned actually quite a lot about it. So I would like to know if anyone has any queries, they can type their queries in the comment section and let us know. Do you do you invest in international markets as well?
Personally, I don't have any. Yes, yes, very good, very good. Personally, I don't have any investments in the international market, but international market is a good idea for diversification. You should invest in international market via ETFs. ETFs are a collection of stocks, so you can buy the FANG ETF or whatever it is via mutual funds. Basically, give your money to the hand in the hand of a fund manager to manage your international investments. Then Shelly Kalra says how to pick small stocks under 100 rupees. Okay, so Shelly, this YouTube this YouTube channel that I have told you about, Raghav's Value Investing. He specializes in picking small stocks. So go have a look at his YouTube channel. Now there are a bunch of ways to pick long stocks. I can't get into it, but Raghav's Value Investing, that is his specialization. He tells you how to pick small stocks only, small cap stocks. So go have a look. Okay. Niranjan is
Nirav,
recording. Is
yeah,
this the
recording.
recording?
Yeah, it
Yeah.
is available in our TalkSkill page. The You guys can view it there. And Nirath has also a question.
Yeah. What is your take on FMCG? Should we invest heavily in IT in ITC? Okay, now I will tell you something. Okay, FMCG stocks, firstly, they are good. Okay, there are some consistent compounders like your Britannia. If you type Britannia on stock screener, you see Britannia will also have rising trend in mostly everything. Okay, FMCG stocks are defensive, means what? They do well when the stock market is not doing well. They do good, they go ulta. So now FMCG stocks will do well, and now the budget is coming up. So budget may now, you know what they're going to do. Budget may they're going to give a lot of money to the rural people, because the rural people are not doing well. Okay, the jobs are down, a lot of unemployment, so they'll give a lot of money to the rural people. What do these rural people do? They will buy FMCG products. So your Dabur will do well, your Britannia will do well, all these companies will do well. Personally, I think, two companies, ITC and Reliance Industries, they have too many businesses combined into one. Okay, ITC has 5 businesses combined into one. ITC has FMCG, they have cigarettes, they have paperboard, uh, and they have two other also. They have agriculture, and plus they have one more also. So they have 5 companies combined in one. So I think that that's like a slow moving elephant. Reliance Industries also. Look at Reliance. Reliance has what? Reliance has Geo, big. Reliance has retail, and Reliance has petrochemical. Unless they separate all these businesses now, only if they separate all these businesses can they do very well. So ITC will give you dividend. ITC will give you dividend 10% a year. If that keeps you happy, invest in ITC. But I don't see it going too much up. Okay. So yes. What is okay? Mr. Hemant Nahar, Praj Industry. Oh my God. Praj Industry just happens to be my favorite stock. Praj Industries in the ethanol sector, like I told you, they make machinery to produce ethanol. They are by far the biggest in India in terms of machinery to produce ethanol. They are a Pune-based company, and they also are into other bioengineering. They make wastewater treatment, and they make breweries and machinery for all that. Excellent company, excellent financials, and I think excellent future. The share price has been in the last 1 year a little choppy. It goes to 400 and comes down to 300 and all, but that not to worry about. If you look at Praj Industries fundamental analysis also, it is an amazing stock. I would really like it. Okay. Mr. Altaf Malwani is asking, what about technical analysis? Do you consider that as well, or just fundamental analysis? I consider mostly fundamental analysis, and technical analysis. To be very honest, I don't look much into technical analysis. I look at a few charts here and there. And to be very honest, what I feel is now, if you own a stock for long enough now, your mind is only a supercomputer which you don't need any charts for. For example, if I own a stock for 2 years, you know, you yourself will know that it cannot fall beyond this level. Or when it's rising, it won't rise beyond that level. So your technical analysis is in your mind only. If you just own the stock for, that's the way I look at it. Of course, there are many different indicators, but mostly I'm a fundamental investor. Any other
Question.
question? Overall outlook is just to invest and not trade. I would advise you, yes, invest, don't trade, because I personally don't know in all these years any successful trader who's made again. It comes down to this consistency. Can you consistently make profits in trading? Remember, we went through this term consistency. Mr. Warren Buffett also, his favorite 3 words I think are durable competitive advantage. Out of that out of that phrase, durable competitive advantage, durable means what? Durable means consistency. I don't know anyone who's into trading and who makes consistent profits. One day they're up, second day they're down. So over the long term, I have not seen it. If there is somebody who can teach you a foolproof method, go for it. Any other questions? Mr. I think Abbas is asking, what are your suggestions for beginners? Okay, for beginners who want to learn how to invest, no, I would say 80% of your money you put it in mutual funds. Okay, there is something called index funds and there is something called ETFs, which are a low cost form of investing. Index funds and ETFs should form majority of your portfolio, and the rest 20% now you put it in big stocks. Put it in big stocks means you need to learn about the stock market yourself. Guys, I actually should start the show with this only. I'm so sorry not to tell you. Guys, India is the place to be for the next 30 years. Let me tell you that. Okay, in my parents' generation, now I keep taking this example. In my parents' generation, lot of people, lot of people made money through land. Okay, so they invested in a piece of land, let's say, and they left it alone for 20 years, and suddenly now they're multi-millionaires and even billionaires. In our generation, it's going to be the stock market. Okay, you're going to take money, put it in one stock, a good stock, let's say a Bajaj Finance or something like that, and you wake up after 20 years, you are a multi-millionaire. So that is going to happen in the stock market. India is a place to be for the next 30 years. We are going to kill it. Okay, so you might as well learn about investing, might as well learn how to pick your own stocks, at least the basics. So when someone is telling you, you can be in a position to understand. Where was I? So for beginners also, you put majority of your money in mutual funds, and the rest you should build up a curiosity. Start reading, and if you're starting, if a beginner start with the best five stocks, the top five stocks in India. Okay, what are the top five stocks? Top five stocks in India are Reliance Industries, TCS, uh, then we have HDFC Bank, we have ICICI Bank, and the fifth one I can't think of. But anyway, you stick to the top five or seven stocks, do your fundamental analysis, start from there. And then as you start making your own little mistakes and learning from your own thing, then you can go into deeper. Okay. All right. Second YouTube channel, yes, SOIC. Okay. Do you hold training courses or classes? Sorry, does already. No, as of now, I don't hold any training classes, but I'm coming up with a course on my own. So, what I taught you, I'm going to deep dive into it, and I'm going to teach you exactly what to look for in the balance sheet, what to look for in the profit and loss account. I think the course should be out probably in the next couple of months. Why
Awesome.
is Gland Pharma falling so much for one bad quarter? Gland Pharma actually was a pretty good stock. They've made a couple of bad acquisitions, and those acquisitions are hurting it. I don't follow Gland Pharma so much, but from what I know, is it is a good company. It is a good company, just going through a bad phase. Another very good company from the pharma space is Loris Labs. Keep your eye on that one. Okay. Strategy buy and hold. Yes, strategy should be buy and hold. That is the best way. That's how people make money. All these famous investors, Warren Buffett said, Warren Buffett made 99% of his money after the age of 50. He wasn't even a billionaire till the age of 50. So buy and hold. That was his mantra. Rakesh Jhunjhunwala also buy and hold. I'm not saying that you shouldn't sell if you get a chance. Tomorrow, if I buy a stock saying that I'm going to hold on to this stock for 1 year, but I see that stock has gone up 80% in 1 year, I'm going to sell it. I'm going to take my money home. Okay, so it's not only that, you have to look at the situation, but the process of picking stocks should be from a long term perspective. I've even sold stocks in a couple of days. In fact, there was one, let me give you an example. Okay, I bought, yeah, I bought Info Edge one. No, I can't remember which. So a couple of years ago, I bought one stock, okay, for the long term. In 2 days, that stock has gone up 25%. I sold it. Does that make me a trader? That doesn't make me a trader. That makes me an opportunistic investor. I bought that with the intention long term. 2 days, I got 25% return on the stock. I sold it. So it's just that. Thanks. Yes, Mr. Ali.
When we should decide to withdraw our money, should it be at certain percentage?
That certain percentage is something that you should be happy with. Like you should decide when you're buying a stock that I'm going to be happy with this much percent return, and then I'm going to sell it. Okay, and that also a fundamental analysis will only give you. And also, I have one video on Instagram where I tell you five five instances when to sell a stock. Okay, out of that is one instance is if let's say a big new competitor comes in. For example, Vodafone Idea wasn't doing very well. There was, let's say, two listed telecom players. Okay, there was Airtel and there was Vodafone Idea. Okay, out of that, Vodafone Idea was not doing very well. It had bought too much. I mean, it had over leveraged itself. There were too much debt. This that. In comes Geo, a big fat competitor. A company that's not doing well, and a competitor like Geo comes in, you might as well sell that stock. Might as well sell Vodafone Idea. So this is how you're supposed to look at it when to sell a stock. When a big new competitor comes in and you can't compete anymore, sell a stock. When the company is going in for a different example, tomorrow, if Infosys says, you know what, we are earning so much money now, we are going to start an airlines, Infosys Airlines. Does Infosys have any prior experience in running an airlines? No. If Infosys starts an airlines, no, I'm selling that stock. That is called change in capital allocation. You got extra money, Infosys, you go in the IT sector only. Whether you want to start in Russia or whether you want to start in China, that's your concern, but do IT business only. Don't tell me you're doing some other business. So these are one of the red flags. You should sell your company. Okay, these are a couple of points. You can look at my Instagram for the other points. Okay, so that was when to withdraw money. Certain percentage, you should be happy with that percentage. Should we average stocks if it falls, or should we book the loss? That is again a very it depends on the circumstance. If you know, if you know that a company is doing company is doing well, okay, it's not that the company is not doing well, there's nothing happening with the company, and the stocks are falling and the price is falling, then average it. But if some bad news is declared, okay, let's say you're holding a bank and suddenly that bank has a lot of bad loans. Suddenly it's come out with its quarter and it's lent money left, right, and center. For example, Yes Bank. Yes Bank was at 400 levels, I remember at once. Okay. In the news, it came out that this company has now given loans to anyone, left, right, and center. They are giving loans, and all their loans have turned bad, and there have a fraud, and this and that has happened. In that case, please don't average. That's like catching a falling knife. You will cut yourself. Okay. So you should judge the circumstance. I would not average with Yes Bank, but I would average example. Let's say now Bajaj Finance has fallen. Bajaj Finance has fallen. Why? It is generally not that the business has gone bad or not that they're doing anything bad. The share price has just come down. I would average in Bajaj Finance right now. So it depends on the circumstance. Okay. Is short term stocks good or bad? That again depends on your method. I'm teaching you fundamental analysis. Tomorrow, if you're learning technical analysis from a trader, that trader will tell you, yes, that it is excellent. Only go for short term and nothing else. So it depends. I'm not saying it's good or bad. It just depends. Sometimes I feel there is an opportunity. Like example, now everyone is looking at these new age companies, Paytm, Zomato, Nykaa, with disgust, for lack of a better word. Okay, all their share delivery, car trade tech, all these new age tech companies, there's so much down. Out of the entire lot, Nykaa is the best. Nykaa is giving little bit of profit. It had a few crores of profit. They are doing good operations. They're run by a proper. Their CEO is also Miss Falguni Nair. She's also running a good show. But that share price is down big time. This, according to me, is an opportunity to buy Nykaa for the next 2 years. It might fall a little bit more, but that's okay. That's a little bit risk you are going to take. You should take. Okay. So this is an opportunistic trade. It's fallen so much, not because it has done some fraud or not because they are going into a business which they don't know about or nothing like that. It's just the general sentiment of the market, the general sentiment of the new age tech stocks, and it has fallen very badly. But the company is still sound. I would say it is a buying opportunity for Nykaa. Please do your own research. Okay. And guys, the budget is coming up. Everyone must watch the budget. And please watch my channel also. I will be giving a lot of information about the budget and which stocks to pick, which sectors will look good now coming up. Okay. We should be in a position to analyze the budget always. Where on TalkSkill page will this recording be posted? I think that Anjali can handle.
Okay, so the recording will be posted on our official Instagram page, so you can see the recording there. Yeah, will be available there.
I
Yes,
think
I
yes.
think so. There are no more questions.
Yeah.
I
Yeah.
yeah.
Great, guys. Thank you so much for tuning in. Thank
Yes,
you.
thank you so much. Thank you so much. Yeah, and guys, for the recording, you all can check out our page, Instagram page. You can find the recording there. And for more stock related courses, you can follow TalkSkill and our website. The course will be available there. And thank you, Mr. Ali, for joining us today.
My pleasure.
Thank
Thank you
you.
so much.